In our strategy, we use a 5-phase framework. We are not predicting headlines or calling tops. We are tracking signals and how risk sequences through the system. The dollar just had one of its largest one-day drops in years. That usually does not signal collapse. It usually signals an inflection where narratives get loud. We are reviewing a market update from Figuring Out Money. The focus is on the dollar, correlations, and what happens near potential bottoms. You should watch the original video for the full technical walkthrough. This move came fast, and it felt dramatic. That matters because sharp moves change behavior before they change fundamentals. This is where people tend to overreact. The dollar moved sharply lower in a single session. This is happening because positioning met uncertainty at the same time. When that happens, price moves faster than understanding. This was the largest one-day drop since early in the year, big enough to move gold, silver, and oil, not big enough to confirm a new dollar regime. A falling dollar tends to lift commodities. This happens because global assets are priced through the dollar. When the dollar weakens, those assets get a reflexive bid. The change is short-term sensitivity. Commodity trades become crowded faster. Mean reversion risk increases, even if the longer trend stays intact. The video compares this to early 2018. Back then, panic headlines showed up near a dollar bottom. This happens because sentiment usually peaks at turning points. This is not confirmation of a dollar breakdown. It is not proof of sustained inflation. It is a warning that correlations are stretched. We are heading into a Fed decision with no expected rate change. Tone matters more than action here. Hawkish tone supports the dollar, dovish tone pressures it. This is happening because the dollar reflects relative liquidity. When liquidity feels looser, risk assets breathe. When it tightens again, the snapback is fast. Gold pushed beyond its weekly expected range. That often signals short-term exhaustion, not failure. Silver exaggerates this because it is higher beta. This hits leveraged commodity exposure first, then high beta equities tied to inflation narratives. Balance sheet strength matters more if this reverses. In our strategy, this still fits phase 1. Late cycle, supported but fragile, not phase 2, forced selling yet. If this way of breaking markets down is useful, subscribing helps you stay oriented around signals instead of noise. It gives you a consistent framework when volatility picks up. That matters most at moments like this. Quick note before we go further. This is educational macro analysis, not financial advice. We watch whether the dollar starts basing. We watch how yields respond after the Fed. We watch credit for confirmation or rejection. Short-term reflexivity increased. Correlation risk is higher. Crowded trades are more fragile. There is no confirmed dollar downtrend. Cash optionality still matters. The broader phase framework is intact. Over the next few months, phase 1 remains the base case. Phase 2 risk rises only if dollar strength returns alongside tighter liquidity. Until then, this is tension, not resolution. We do not need to be early. We just cannot afford to be late.